Hi, my name's Roy Thompson. I head up Carpenter Box Financial Advisors, and welcome to this edition to At the Coalface. The purpose of this series is to really start to talk with investment managers who are managing money on a day-to-day basis, who are looking at the data that's coming through, rather than simply looking at what's happening in the media and drawing an inference on what might be happening in investment markets. So with me today, I've got Henry Wilson. Henry is an investment manager at LGT. LGT are one of the investment companies that we use on a regular basis. So hello and thanks for joining us, Henry.
Thank you. Thanks, Roy. Good to see you.
So I guess, from my perspective, there's quite a bit to unpack. It's been a few weeks since we last recorded such a video. I see it that over the course of the last month, the sort of anticipation or excitement of January and February, where investment markets had started to imagine an end to these increase in interest rates and deflationary environment, all of which was being received as good news, and investment markets were going up. I guess from sort of midway back end of February through into the beginning of March, we had a reversal of that where people became very worried about inflation again, and sort of conversations about the terminal rate or this phraseology, the terminal rate for interest rates. I don't know if you can just describe to us, perhaps what's meant by the terminal rate and what happened perhaps about a month ago with some of the data that was coming through, specifically in the US, but again into the UK.
Yeah, of course. So just starting on the terminal rate. The terminal rate really refers to when we talk about interest rates, central bank interest rates, it really refers to the kind of end rate. People talk about how high will it go? What's going to be the terminal rate of those interest rates? Will it keep on going up and up and up? And what level is it that will be the terminal rate? Clearly, the higher that interest rates go up, the more restrictive monetary policy is, the more tight conditions are in terms of lending conditions, mortgage conditions, etc. So it matters because not only does the terminal rate matter, but the length of time that it settles at that terminal rate is important. The longer that it remains higher, the more restrictive monetary conditions will be. Whereas if it goes up to a certain level, hits that terminal rate, and then they cut them quite quickly and cut them in a big amount, then actually monetary conditions become eased quite a lot, despite the fact that you did potentially hit quite a high level. So, the important thing is not just the terminal rate, but also the length of time that it is left at that terminal rate. In terms of the last couple of months, I mean, it's amazing how quickly things move in just a short period of time, and it's amazing the amount of kind of aeronautical references that we've had over the last few months. We've gone from a soft landing to no landing to a hard landing in just the space of kind of 6 weeks or so. And coming into the year, there was a real hope that the Federal Reserve might be able to achieve what's known as a soft landing. Now, what that means is you bring down inflation and you bring down economic growth to a level where inflation is within that comfortable kind of 0 to 2% level, which is where the Fed is happy. And economic growth comes down because you need growth and inflation to come down together. But what happens is that you're able to bring down growth to such a level that it doesn't go too negative. So you might have a small minor technical recession, or it might be just a tiny bit positive. But the critical thing is that both inflation and growth come down, but not to such a level that you end up with deflation or with negative economic growth or too much negative economic growth. That's quite hard to do. But there was a hope that, inflation was coming down, the data looked quite good. There was a hope that we were moving in the right direction. About a month later, what happened is we ended up getting some data that was much stronger than people expected in terms of some of the CPI data showed some growth instead of kind of slowing growth. It actually showed growing pricing pressures again in certain areas like shelter, etc. But also some of the unemployment data came in, and it showed that unemployment had actually ratcheted down, which indicated that tight labour market, which was one of the reasons why inflation was so strong, was actually remaining an issue. So suddenly, having gone from hopes of this soft landing, the market suddenly shifted to this idea that actually growth was still resilient, inflation was still pretty resilient, but actually we might have what's known as a no landing, which is when actually you don't get either inflation or economic growth to come down, and they both remain above expectations. So now, the market really didn't like that because in a funny sort of way, I know that normally economic growth is meant to be a good thing, but actually what that indicates is the Federal Reserve might have to raise rates up even further than people expected.
Okay,
and obviously higher rates means more restrictive monetary policy, which is generally bad for bonds and is generally bad for some equities as well. Did you ask a question, Roy?
Yeah, no, so forgive me. I was just going to say, so, the upturn of that is the market then start to price and interest rates going up further and perhaps for longer. And the outcome from that would be that the consumers would have less in their pocket, lower economic growth, which is bad for investment markets. So, and that's perhaps why we saw a fall then, in stock markets, for example, through the back end of February and into March.
Correct. That's exactly right. People became quite concerned that this restrictive monetary policy would really cramp down on growth, would be bad for bonds. And it also kind of made people concerned that the Federal Reserve maybe didn't have control of the situation. So they kind of said, look, leave it to us. We're going to raise rates. We'll get economic growth down. We'll get inflation down. It's really important to us. And all of a sudden, their credibility was on the line as to whether they actually had control over the inflationary situation. Now, fast forward another month forward on from that, or not even a month, really, just a couple of weeks or so. And you've had issues in the US relating to a handful of regional banks. So Silicon Valley Bank, Signature Bank, and another bank. And then you've also had issues in Europe, primarily just to do with Credit Suisse. Now, all of those concerns have actually meant that bank lending standards have ratcheted up. It's become harder to take loans. It's become harder to take mortgages in the last few weeks. And what that means is that economic growth is expected to slow down. If you're a business that's reliant on loans, or if you're looking to buy a house, if lending standards rise and it becomes more difficult to get that mortgage, economic growth generally will slow down. And so instead of going from soft landing to no landing, people are now forecasting that we might see a bit of a hard landing later on in the year, where economic growth slows down because credit growth is slowing and because of the lending standards have risen so much. So lots of different landing types of scenarios. I think it just really shows how quickly things can move. And what's happened in that period is that the terminal rate of interest, I mentioned it earlier, is that kind of the peak interest rate. Instead of markets were expecting that it shifted from January, February time from 4.6 up to 5.6 as the peak. And today it's back down at kind of 4.6 or so. And it's expected that they'll cut interest rates, not in 2024, like it was forecasted just a few weeks ago, but now in the latter half of 23. So it just shows that instead of going higher and higher for longer, actually now it might go a little bit higher, but then they'll cut it quite soon, which should be, on the whole, quite beneficial for monetary policy, monetary liquidity, etc. But the big question is, why are they having to do that? If they're having to do that against the backdrop of a poor economic situation, then clearly that's, just it really depends how bad is the economic situation behind it. Because if it's a little bit bad, then that's quite good. But obviously, if we're going to see a big, deeper recession, then that would obviously be bad.
So, the nub of that is changing from these, you've defined them as three different landings: a soft landing, a no landing, and then a hard landing. In such a short space of time. All this evidence is the market is very, very volatile and susceptible to news that comes out. Yes. I would imagine if I was a consumer sitting at home, I'd be reading the news about the banks and going, oh my God, it's almost 2008 again. I think you alluded to me in sort of conversation before this call that perhaps there is some strength in certainly if we look at European banks as an example, that you would not envisage 2008 being revisited. Is that a fair statement? Or
So I mean, look, I think clearly it's alarming reading stories about banks facing issues and whether depositors will be made whole, etc. That's awful, and it is quite concerning. But if you take Europe, for example, we think that the European banks are now in such a different situation to 2008, 2007. They're highly regulated entities. They're quite boring businesses, actually, to be fair now. They're more like a utility than the kind of quite sexy investment banks that they were a couple of decades ago or so, nearly now. Credit Suisse is a bit of a different one. We think it's a bit of an outlier in terms of the wider European banking system. They have been victims of their own horrific mismanagement over the last decade or so. And so, in many ways, it's not so surprising that they've succumbed to this UBS merger. But in Europe, we think that actually, on the whole, the banking situation is much more secure than a couple of decade and a half ago. In the US, again, we wouldn't really compare it to 2007, 2008. With some of the issues, for example, around Silicon Valley, very specific issues around the fact that they had a very narrow depositor base, client base. They were all kind of Silicon Valley tech/VC venture capital investors or businesses, and it's been a very difficult time for that sector. So the fact that they've seen big outflows of deposits is not such a surprise. But the main thing I think really is that central banks, regulators, they've learned the lessons of the past, and they've shown that if you don't underwrite depositors in moments of distress, it can lead to wider contagion. And so they moved quite quickly in the US to kind of prevent contagion.
Yeah.
One of the concerns, or one of the criticisms of the Swiss regulator, is that they didn't move quickly enough or swiftly enough with Credit Suisse to say that they would make all the depositors whole a couple of days ago, and that led to kind of further deterioration of share price and concerns around the overall solvency of Credit Suisse. But I think in the US they've moved quite quickly, and they've kind of helped to nip it in the bud. Again, we don't know if things will kind of move on from here, but mainly in the UK, much better situation than before. Don't envisage another 2007, 2008 style issue. The issues we're seeing at the moment are more liquidity related than solvency related, which is there is a difference between the two.
So the liquidity issue goes back to what you were saying. Banks perhaps moving forward being more reluctant to lend, which will add to this contraction, within the economy, or has the potential to add to the contraction within the economy. And if you have that, arguably you don't have to press the accelerator so hard on increasing interest rates. So I guess then sort of central banks and stock markets around the world will be looking at this information moving forward, and trying to balance those things. It feels to me that it's quite possible that you could have some particularly good days in things like the stock market moving forward, and you could have some more bad days depending upon where the market thinks it's going, whether it's going for this sort of soft landing or this hard landing, or indeed anything in between, based on what you've just said.
Yeah, you're exactly right, Roy. I think, number one, we're in a situation where liquidity is being tightened across the board, and there is typically quite a high correlation or kind of sensitivity between liquidity levels and volatility. So, i.e., how much stocks are moving around, things like that day to day. And as you take liquidity out of the system, ordinarily volatility goes up, i.e., stocks become more volatile, they move around more, there's more uncertainty around share prices. And so we should expect that while interest rates continue to go up and liquidity remains tight, that share prices will remain quite volatile, bonds might move around a fair bit. But I think markets do this, and day-to-day stocks do move up and down, and that's just something that we're all aware of. One thing that we've really kind of hung our hat on the last few weeks, and we've been really kind of relieved about, is the fact that we do first and foremost try to identify companies that we would describe as being high quality. So they have low debt, ideally loads of cash on the balance sheet, experienced management teams that have been around for a long time, businesses that have been around for decades, if not centuries, strong business moats, strong business models, etc., unique products, all the types of things that make them resilient and adaptive to change, and makes them more likely to weather these storms, whether that is through high interest rates or high inflationary pressures. We just know that they're going to be here in not just 5 or 10 years' time, but 20 or 30 years' time. We typically avoid things like banks. We typically avoid things like, we've long avoided typical kind of commodity companies, because those types of businesses, their returns are out of their control. Their returns are very much driven by things like interest rates or China growth or the growth of another part of the world that's completely out of their control. They're highly capital intensive. They're highly cyclical, which means that they go through periods of being, top of the pops to being bottom of the pops and, going bust. And so we avoid those types of companies more or less. And it means that we're actually, we've been in a really good position the last few weeks in terms of knowing that we've got rock solid fixed income that's done very well. On the equity side, we own a collection of high quality companies like Unilever, Diageo, Nestle, these types of companies that have been around for 100 odd years that are going to be here for the next 100 years or so.
You mentioned in there about commodity prices or commodity stocks. I guess one of the things that would help that notion of a soft landing is a further easing of things like oil and gas prices. I noticed in the last week, with some of this credit, concerns around the banking sector, you've also had a drop off in some of those commodity prices. Is that right? Is that a fair comment? And
Yeah,
the impact of that, I guess, would be helpful for that inflation story.
definitely. Lower commodity prices, whether that's through oil or natural gas, really helps in terms of bringing down inflation. And it also helps in terms of if you take some like the UK, for example, where the government is capping energy prices, it means that the amount that they were expected to spend on capping energy prices was meant to be 150 billion. And it's not been nearly as bad. So it's actually helped them. It meant that the chancellor's had a bit more money to deploy during the budget. And it means that the UK budget deficit is not nearly as bad as it was expected to be. And it also means that me, you, all of us, we're expected to not have as high energy bills as we were anticipated to just a few months ago, which means that we have therefore more money, or we should have later on in the year, more money to spend on other things. Yeah. All things being equal, we can spend more in the pub, more in a restaurant, more in the cinema, watching a game of football, whatever it is, and it's more money to just go around the general economy, which is clearly good to kind of prop up an economy that's suffered a bit.
Yeah, good. But Henry, I really appreciate your time joining us today. It's a complex environment for sure, and what we're seeing is it changing week by week. So I appreciate you trying to explain where we are and what's important just at this point in time. Thanks very much.
Thanks a lot. Cheers.